once the filing deadline or once the end of the year, actually, so December 31st, and I'll caveat that with if you know you were going to make some changes to an agreement to fix that on December 31st, you can make your changes to your operating agreement, I think up to March 15th in the following year for the prior year. But once those deadlines have passed, it's set in stone. And if you're one of those firms who doesn't get your taxes, you don't constantly keep your books tax ready throughout the year, you're probably going to wind up in a situation where by the time you figure out you have a problem, it's already June and you can't do anything about it. Okay. So again, the message here is have your professionals talking to one another. If you're a passive investor, make sure these syndicators professionals have talked to one another. Ask that question. It's a fair one for them to answer. And if they stutter, it hasn't happened. Okay. So be wary of that.
You're listening to the Real Estate Runway podcast powered by Quattro Capital, where we're all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, Chad, the investment maverick.
All right. Real Estate Runway family. Welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton today, and I'm actually going to do a little solo episode today, a little monologue action. Before I do, if you get any value out of this or anything else Quattro puts out, look, just like it, subscribe to it, share it with someone you know. That's how we gain traction. That's how you pay it forward, and more people like you get to hear this message. So please do that. Today, I want to talk about the massive issue of having your professionals talking to one another. And let me qualify that. So whether you're a passive investor or whether you're an active investor, meaning if you're investing as an LP in others' deals, limited partner, or you're actually the one syndicating and sponsoring the projects, something that is often overlooked. Let's just talk about your team for a minute, right? You are likely going to have, just on the core team, an attorney for your real estate transactions. You may have a different attorney that structures your syndications or your legal framework that is the actual deal. So I'm thinking about like the private placement memorandum known as PPM, the operating agreement known as the OA, and everything that goes along with it. If you're doing 1031 work, maybe there's a tenant in common. If you're accepting 1031 money or doing a 1031, you're also going to have a situation where you have a qualified intermediary involved. Just silenced my phone there, saw that was going. That's someone who actually handles the transaction and handles the taxable paperwork there. You're going to have some kind of an accountant involved or a certified public accountant known as a CPA who's really going to handle all things tax return, bookkeeping. In some cases, you may even have a bookkeeper, right? So here's the rub. I have actually made this mistake and I see others make it all the time. So I'm going to give you 2 or 3 stories depending on time here of how this didn't go well. If those people, namely the accountant, the structuring attorney, right? And that attorney may be a tax attorney, a syndication attorney, and a real estate attorney, or it may be all 3 people, right? In different, which I recommend. You should have specialists in that world. Let's just think about them for a second. So I'm going to tell you a story about a certain deal, a framework we were using in our deals that actually bit us in the rear end simply because while we're pulling it all together, we had someone looking at it through their tax goggles. We had someone looking at it through their state law goggles, but nobody was actually putting those together. Okay. So picture that we have a pair of syndication documents for a property, okay, that we're putting together. And we decide that we're going to give the investors their pro rata share of the income and losses that are allocated. So from a real estate perspective, this is the simplest structure possible. So pro rata means whatever percentage of the money you get that percentage ownership in the property income, the property sale proceeds, and also the property operating losses for your taxes and depreciation, which is technically an operating loss and things of that sort, right? Well, let's make it a little more complicated. And this was a project where we were running the deal. So we put a little money in the deal, but we have a larger pro rata interest for that deal than someone who brought the same amount of money that we do, because we have the sweat equity part. We're doing the work, we're operating, we're bringing the professionals, the expertise, all that kind of stuff. So let's just say that the investors who brought money and are limited partners, they have no control or no operating responsibility, they own 70% of the deal. Let's say we own 30%, but we did not bring 30% of the money. We brought 10% of the money, right? So that means I have a disproportionate share based on the money that I brought. Well, we set up the operating agreement so that there was the appropriate split on all incomes of the property. So that is cash flow, that is refinance proceeds, that is sale proceeds, all the money that could come in. Okay, pretty clear. It's split 70-30 between the managing partners and the members. And so that's all hunky-dory. Based on taxes, we said, okay, well, also for losses, you're going to get your 70%, we're going to get our 30, right? We wrote that in stone, signed it, everything's great. We go to file taxes about a year later, and the first year was fine. We didn't notice it. The second year, what actually had happened was, because we had less money in the deal for the amount of interest that we got, we were getting a larger share of intending to get a larger share of the taxable losses. And so here's where that became a problem. We only had so much money in the deal. We took some losses the year before. This is where the term capital account comes into play. And I don't mean capital account as in a bank account with capital in it, right? That's a different kind of capital account. This is the accounting version of capital account, where it's like, okay, if everyone invests $100,000 in a deal, their initial capital account on the balance sheet, this is the snapshot of all the assets, liabilities, and equity in a company, right? Which these are companies that own real estate. It would have for the investment, the equity, it's going to have a positive $100,000 for every investor, right? Well, let's say you take $100,000 in operating loss via bonus depreciation or something like that in year one. Well, now your capital account has actually gone to zero. Let me see if I get this right. It's actually gone to zero, right? And so if in year two, you plan to take another $100,000 in operating loss, your capital account goes negative. It will become negative 100,000. And for those of you who are keeping track, if you've ever heard, okay, I'm taking bonus depreciation on a deal, but when it's sold, I have something called depreciation recapture. Well, that's simply a deficit restoration obligation. That's what is the tax term for it. It's simply like, okay, your capital account is a negative 100,000. Well, you're going to have to recognize 100,000 of phantom income. Like it's actually income that you don't necessarily have money for, to bring that back to zero. Ideally, you've made enough on the sale that you're actually getting that money, but that will be taxed differently. It will not be capital gains. That would be ordinary business income, and then you can kind of capital gains it from there. So rabbit hole, sorry, that was a squirrel. Let's bring it back to the tree. So the tree we're talking about is, this is what had to happen for us to be able to take our losses, right? Well, we didn't have the proper language in our documents that allowed us to let our capital accounts go negative, and then subsequently have a clause around deficit restoration obligation that means, okay, well, when the property's sold or the business unwinds, you have to restore that capital account to zero. You can't just file with a negative capital account on your taxes. The IRS doesn't allow that, okay? Here's how that played out. And this is simply because we had our tax attorney and our tax and our CPA read the documents for their context. And we had our syndication and real estate attorneys read the documents for their context, but no one talked to one another, right? No one said, okay, we know they're going to plan to do this, this, and this. Okay, what about this as far as this clause? Well, here's how that played out. When we went to file taxes, what we had written in the operating agreement wasn't allowed, because we didn't have the ability to go negative on capital accounts. And so where we were planning on having, let's just say the number is, I was planning on having $500,000 of operating loss to cover some other income that I had. I only had like 100, right? Because my basis in that deal was only 100. And you can, unless things are written otherwise, you can only take basis down to the amount of cash you have in a deal. So very simple solution that would have been avoided, and it cost me, like a 5-figure tax bill that year that I had to stomach and handle, and just take that as a lesson learned. So I can't emphasize enough that had all we done was play coordinator and sit down with all the members of the committee, if you will, the committee being our accountant, our tax attorney, our syndication attorney, and our real estate attorney, and say, hey, here's the intent we're trying to accomplish, and run through that and make sure they all agree that the documents read how they need to read. So I'm telling you, once the filing deadline or once the end of the year, actually, so December 31st, and I'll caveat that with, if you know you were going to make some changes to an agreement to fix that on December 31st, you can make your changes to your operating agreement, I think up to March 15th in the following year for the prior year. But once those deadlines have passed, it's set in stone. And if you're one of those firms who doesn't get your taxes, you don't constantly keep your books tax ready throughout the year, you're probably going to wind up in a situation where by the time you figure out you have a problem, it's already June and you can't do anything about it. Okay. So again, the message here is have your professionals talking to one another. If you're a passive investor, make sure these syndicators professionals have talked to one another. Ask that question. It's a fair one for them to answer. And if they stutter, it hasn't happened. Okay. So be wary of that. Now, story number 2. I have a similar story that was not my mistake, but it was an investor friend of mine. Okay. Someone who's invested a lot of money in our deals. And here's what transpired. So this individual did a 1031 exchange. Okay. Those are notoriously more complicated when coming into a group investment. So walk with me here. I'll use some terms. I'm not expecting you to understand the structure. I want you to understand the mistake. Okay. So first thing that happens, he sells his property. Money goes to what's called a QI, a qualified intermediary. This is basically a legal firm who will hold the money. Like, it has to be an arm's length transaction. They will hold the money. If you're doing a 1031 exchange, you can never receive that money in your pocket. Okay, so don't do it. You'll mess it up. IRS is very strict about this. That starts his clock for a 45-day identification period where he gets to pick up to 3 properties he might want to exchange to, and then within 180 days, he has to close on one or all of those properties. Well, he identifies one of our portfolios as where he wants to put the money. That's great. We start to set it up. So what we do is that there's a couple of ways you can do this, and I'll just quickly, another squirrel here. If you are a passive investor and you're looking to set up a 1031 exchange into a group investment, there's about 3 ways you can do it. One of them is called a Delaware statutory trust. There may be others, but these are the most common. The Delaware statutory trust, I don't like it. If you're looking to clip a coupon and go to a company that only accepts 1031 exchanges and be part of their deal, that's great. You'll probably get 5 or 6% return. It's not, I don't think it's that great. And there's a lot of, you can't do things like refinance the property and all that kind of stuff. So just put that to the side. There's the 1031E concept, which is newer, and that's a whole nother rabbit hole. So I won't go down that strategy, but you'll see us using that a lot. And then there's the tenant in common structure, which is where the exchanger has to exchange his real property interest, which is real estate, for real property interest. He or she cannot implement an exchange where you're exchanging real property interest for membership interest in a company unless certain conditions apply. So that's where the tenant in common comes in play, where it's like, okay, well, we, the syndication, are going to own, let's just say 90% of the property, and you're going to own 10 because you're bringing 10% of the money, right? So he goes down this path. We set it up, and we set it up as, okay, he's going to be a 10% tenant in common with us, the syndication over here. And we structured those documents. Well, we got them structured. It looked right. The structure was right on our side, but his tax attorney and his real estate attorney never talked to each other. And his qualified intermediary, those 3 parties never talked to each other. And so what we had happen was there was a mistake. The exchange was done one way, and the structure was set up another way, where a different entity owned the property than the exchanger, a new entity. And that was a mistake. That this investment has since finished and sold and all that kind of stuff, and it's way years in arrears. But had someone picked up on that at the IRS, it would have been a big problem that we would have had to go through a lot of work to fix. And it's simply because the qualified intermediary did not talk to the attorney who was structuring the stuff, or they didn't, vice versa. I can't say enough about just making sure that the professionals talk to one another. Okay. And I think we have time for one more, I think, to kind of drive this point home. So let me Okay, so I'm going to tell one more story, and this one could have gotten scary really quickly, right? We had another 1031 investor, okay? And there's a reason a lot of syndicators don't do this, because it's a pretty complex transaction, and there's a lot of moving parts, and we do it. We've got it figured out. But even in the investors world, if not everyone is talking to one another, you have a problem and things can get missed. Well, this is a situation where we did a tenant in common 1031, and the legal structure was set up and all that kind of stuff. And 3 years down the road, we're owning and operating this property, and we find out that the certified public accountant, the CPA for this individual, hadn't been giving him his appropriate allocation of income and expenses. And it wound up holding up a tax return 3 years later that we now had to go back and refile for the 2 prior years. And it was because his CPA hadn't talked to his attorneys and didn't know really how this thing was set up and didn't know how it needed to be allocated. And so it was getting allocated like another K1, which is not correct. So that actually caused that investor 3 years worth of lost depreciation, and he doesn't get it back. Like it was, I think they can go back and correct the return for the allocation of income and expense, but you can't get that depreciation back that was lost in the given year. So that was to the tune of a few $100,000 in losses. So I'm going to kind of conclude it here. I'm not going to drone on and on about this. I just wanted to get a message out there to you folks. Whether you are a passive investor and you're investing in someone else's deal, or whether you're an active investor and you're putting deals together, probably more so if you're an active investor, you really, really, really need to make sure the people you have involved in structuring that deal have communicated. And even if it's you getting everyone on a phone call or taking everyone to a boardroom and talking about it, you need to be on board before documents are drafted, and everyone needs to be on the same page with what you're trying to accomplish, because then things will get seen through multiple lenses. And to drive the point home, a tax attorney thinks about IRS tax law. A real estate attorney thinks mostly about state law, because that's what governs real estate transactions. A business attorney who's going to structure operating agreements and stuff, sometimes that's the same as a real estate. They're thinking about state law. The accountants, they're thinking about tax, what was the right word? The tax rules, the tax code. Like, how do you actually apply the code that is in place, right? And so when you think about that, beauty is in the eye of the beholder, and everyone has a pair of glasses. And when they put these glasses on, I'm trying to do this on camera, y'all probably think I look like a moron, but putting this in place and looking through the glasses that you know to look through, look, a surgeon is always going to see something that needs to be cut. A functional health medicine doctor is going to look at something and think he can solve it with oral supplements and things of that sort. A pharmacist is probably going to look at things and think medicine is the solve for this. So and forgive me if you were any of those things. I totally generalize. I'm clearly not one of them. My point is, you are going to look at things the way you were trained to look at them. And this is why communication and collaboration is so hard, is you have to get those multiple perspectives. And as the one putting deals together or the one investing your hard-earned money in the deals, you need to make sure that diligence has been done. Okay? Now, I'm going to end it here. I got to go record another episode with a wonderful guest who you'll probably hear after this episode. But this has been another episode of the Real Estate Runway podcast. If you got any value out of this message today, share it with someone who needs to hear it. There's a little share button, a little box with an arrow. You can do that. Like it, give us a review, swipe it, whatever you're watching this on, just interact with it. That's the only way to pay it forward. And we look forward to seeing you on the next show. Take care for now.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com and scroll down for more info. Until next time, this is the Real Estate Runway podcast.